You're the owner of a small business, which means you're also the tech guy, and HR, and personal assistant, and head honcho, and intern. You could use another pair of hands, like the experts you'll find at Verizon Small Business Days, April 21st through 27th. Get a free tech check, special deals, and more. Call 1-800-483-4428 or visit verizon.com/smallbusiness to book your appointment. Verizon Business.
Reality radio for a really great future. We're talking real money.
Hi there, I'm Don, that's Tom. Welcome to Talking Real Money, the program that has existed for a very long time, designed specifically to help you get a reasonably good education about money. We're not going to latch on to the latest hot trend. We're not going to pander to you just because it's what you want to hear. We're going to try and always tell you the truth, even if the truth hurts. 855.
And sadly, go ahead with the number.
855-935-TALK is the number to call to get those hard answers to your questions. 855-935-8255.
And sadly, in many ways right now, if you were a saver for retirement, it is kind of a tough place because you can't really put it in something that's going to pay much that is relatively safe. So people are looking for other ways to create retirement income that are easy, Don, and pay a lot.
Oh, and safe as can be and responsible. And this leads me to another one of Dow Jones' irresponsible publications that will pander to anything you want as an investor. And here is their cover story from this week. Yes, you can retire on dividends.
By the way, it doesn't say the subtitle, which is, take this pill before chocolate cake and you will lose weight.
That would be a very appropriate one for this. Because, first, as we mentioned last hour in response to a caller or yesterday's podcast, dividend stocks, for some reason, people think they're safe. I think it's only because they've been going up. I think whenever they've been doing something, we think they're going to continue doing that.
Recency bias. And remember, basically all stocks have gone up in the last year. It's 96% of stocks have increased in value. So that's nothing to look at. Part two of that, if you really just buy dividend stocks, this one recommends 10, which is an outrageously undiversified portfolio. But in general, if you just want to buy dividend stocks because you think there's some magic to the fact that they're paying more, you're already limiting yourself to about half of the stocks that are in publicly traded. So your diversification is going down. And we would never tell you to own 10 stocks of any sort because that's just wildly risky.
Well, and the other thing is, and as I was starting to mention, which I mentioned before, they're not safe. We tell people in our classes, do not put 100% of your money in stocks, diversified stocks, 13,000 stocks around the world, if you can't stand the potential of a 50% loss.
Decline
in value in a 1 year period. Well, folks, the worst case scenario for dividend stocks in the past was about a 60% decline. 60%. That is not safe by any stretch of the imagination. And what Barron's is suggesting is 10 stocks. 10 stocks. Now, that is inherently unsafe. And you may say, well, they're AT&T, Coke, Con Ed, IBM, Johnson & Johnson, Kellogg, Procter & Gamble, a real estate trust, U.S. Bancorp, Verizon. They can't go out of business.
I'm going to go back in 15 years and say, well, that's true. Neither could Washington Mutual, Enron, or Blockbuster. These are all great companies.
Or Delta Airlines, or General Motors. Sure. Or WorldCom. You know, you got Verizon in there and AT&T. WorldCom was bigger at one point than some of these.
But setting that aside, here's the thing I think that where the rubber meets the road for me is people believe there are stocks that will pay you these high dividends. There's a magic to it. You just find the right ones that are paying higher dividends. Why are most of these paying out these dividends, which I think I read somewhere in here, there's one of them paying 4.5 or something?
No, wait. AT&T is currently paying 6.9% dividend. There's a problem with that dividend. That's telling you the company's having trouble.
Yeah, exactly. Generally, my take was when they pay that higher, they're trying to get you to buy the stock.
Or their stock is way down and they haven't lowered their dividend.
Exactly. They haven't lowered the dividend. The price is down. And by the way, if the price is down, it's one of the very few that's down over the last year, because we mentioned 96% are up over the last year.
So the point is, this is an incredible point. Buying dividend stocks is not a safe way to increase your retirement income. And shame on barons for making it appear that that's the case. This is the problem with most of the popular financial press. They mislead.
Tom and Don are talking real money.
A second opinion could save your life either physically or fiscally. Let one of our Vestory advisors help you save your future at Vestory.com, Vestory.com.
For your real life and real future, Tom and Don are talking real money.
Hi, welcome back. Don here, Tom there. 855-935-TALK is our phone number, 855-935-8255. Also, remember, you can send questions in at talkingrealmoney.com on the contact form. And Robert.
By the way, one of the things to be a good investor is to be patient. Robert has been very patient in getting on the show. Yeah. So
he may be a Robert, good investor. Hi, Robert. Welcome to the show.
Good afternoon. Yeah, I enjoy your show. First, I got a couple short questions. One is, I know you talked about be careful when you have people talk to you about investments and stuff. And I had been let's just say I saw online where I have some money that's in what I call safe money, and then some in some investments. Mutual funds, 500 index funds, but some sitting on the sidelines a little bit in it nowadays, it earns literally under 1%, like you had mentioned. And I thought I'd seen, and I know typically the annuities don't get a good reputation, especially the variable ones, but I thought I'd seen where there was a fixed rate, like 3-year or 5-year annuity that you could get a guaranteed payout on after 3 years or 5 years at about 2%. What's your take on those? Or that fees that I have to be careful with.
Well, no, there aren't fees on fixed annuities like that pay 2%. I've even seen some that pay 3%. But the word guaranteed is a bit misleading, because it assumes that there is an absolute certainty, no doubt whatsoever, that you will collect your money. And bear in mind, the guarantees are generally only as good as the company that backs that annuity, which is why when you look up fixed annuity rates, you'll see they vary at the high side from right around 3% to the low side of 1%. Now, why would an insurance company pay 1% on an annuity when some of their competitors are paying 3%? It's because they're a more responsible insurance company. They're A+ rated. Conservative. Yeah. They're A+ rated. The ones paying 3% are low rated insurance companies.
Well, even at 2%, if it's a rated A company, after 3 years away, they told me that I could let it carry over to another 3 year, kind of like a CD.
Of course you could, but Robert, here's the thing. What leads you to believe that there is a 100% ain't no doubt about it guarantee?
Well, I know that they're not FDIC insured like money in a money market fund or something like that. So you only have the faith of the strength of the company that you're investing in. and so I understand there's a risk there. But
okay. Good. As long as you understand that, because remember, AIG, if it wasn't for the government bailout, there would have been millions of people who lost money in AIG annuities.
Sure. Okay. So I guess I just was thinking
everything's a trade-off.
Yeah, that's a trade-off. Because even CDs, you can't even hardly get a percent anymore.
Well, we just said.
But again, they're absolutely safe because they have the full faith and credit of the U.S. government backing them up.
I understand. Okay. That kind of gives me some good guidance there. Second question is, my wife and I are retired. We live in a home that we've been very frugal over the years and have had the ability to pay it off. And then we are considering buying a home in Arizona to more as to live in, and then renting this home up here. Would that be?
I would not be a huge fan of that.
To make some positive cash flow versus what I can do. In other words, I know real estate is also risky, but I was considering doing that.
Well, real estate is it's both things, Robert. One, real estate is risky, and it can be as risky as stocks. And two, real estate, when you're owning an individual piece of property, it's a job. Whether you think it is or not, it's still going to be a job. Even if you hire someone to handle all the work, you're still going to have responsibilities that you have to handle and unexpected costs. And also bear in mind, and this is a problem with the Seattle area particularly, recency bias comes into play in Seattle because prices have gone up for so long that no one believes they can ever go down.
They don't go. Here's the thing, okay? And we didn't ask Robert how old he was, and thank you for your phone call and thank you for listening. But in retirement, liquidity. I mean, you need money to pay the bills. Why would you have one investment? There's no liquidity, right? The house, which is paid for, and then go buy something else. And part two, Seattle aside, real estate can be very illiquid because if you get into a down market and you don't want to sell as prices have gone down, well, now you can't even unload the thing at whatever price you need to get the money. I wouldn't be running off and buying. Well, personally, I wouldn't buy real estate here.
He said they were going to buy a house in Arizona to live in and then rent the house in Seattle.
I wouldn't do it. No, I wouldn't.
Or in the metro area. I would not do it. Not on a bet.
This is something else.
I've been a landlord. You've been a landlord.
Well, yeah,
I wouldn't do it on a bet.
Still am. And we can talk more about that. But here's the thing. Here's the thing. In today's world, if you just said, I want to be out of Seattle for 3 months or whatever, and I want to go live here, you could do anything with VBRO, whatever you want, whatever rental place you want. You can go stay wherever you like for whatever price you can find. The price, and there's various prices, et cetera, et cetera. Because I'm going to Arizona in a week. We got a house. We're all by ourselves, and it's very nice. I mean, so I just wouldn't do it if it's a lifestyle thing. No way.
And remember, when you own a rental property, you have to hope that the bank does the right thing with the.
You're going to make me go there
with the taxes. You got to hope that the bank pays the taxes.
All right, you might have thought Wells Fargo was the worst bank and I'll just say it right here: Bank of America. Bank of America holds the note on my wife's condo.
And they have the escrow account. They have your escrow account.
Last 3.5 years, they very, very, quick to collect the money to pay the taxes and insurance. Guess what? They had the wrong tax parcel number off by 1 digit. So the money they paid into the county didn't get registered properly. The taxes didn't get paid. They got notices, by the way. We asked the county that they hadn't been paid. Now, the next thing we know, we get served last week with the paper saying that the county is going to foreclose on the condominium because the taxes are unpaid. That's bad number one. But bad number two is my wife called them over a week ago. Do you think they'd be anxious to resolve this? No, they're we'll get back to you. No problem. We'll take care of this later. I mean, that to me is totally outrageous.
It's not just Bank of America's behavior, but it's King County's too.
I agree.
We collected the money for the wrong account. Oh, well, tough.
Sorry. Yeah, that's the way it goes. Yeah.
Oh.
Tom and Don. Don are talking real money.
Tom and I created Vestory to help everyone become a better investor, even those who will never be clients. Let one of our advisors help you start your financial plan or solve a money problem free with no obligation or high-pressure sales pitch at Vestory.com. Vestory.com.
Your guides to a really great financial future. Tom and Don are talking real money.
Hi,
I
welcome
was feeling
back
a little
to the
sleepy
show.
until then. Yeah.
Oh,
You got the energy going now.
855-935-TALK. That's our phone number. Give us a call. You can also send questions in at talkingrealmoney.com, as did this person.
Why
And that's why I'm laughing at this
funny.
question. You want me?
Yeah.
I'm gonna tell you why it's funny right
Okay.
now. I'm gonna
All right.
read you the question. Ready? Hi, Ron and Don.
That happens from time to time.
Yeah, I know. I have a question.
By the way, some guy called you John the other day in the office just
whatever.
to even the score a little bit. So whatever.
All right,
I don't
Ron.
care. But
It's fine, Ron.
yeah, good for
Dan.
kind of like Ron. I like Ron.
Yeah.
Rolls off the tongue.
Ron Burgundy.
3 letters.
Yeah, it's good.
Ron Burgundy.
I'll be
Yeah.
62 in a few months and plan to retire in mid-2023. My husband may wait until he's 65. I can go under his medical insurance until I'm eligible for Medicare.
Yeah.
But that's all doesn't matter. Here's the question.
It does matter because it's very expensive to just go out and buy. Through
I
the
know, but it doesn't have
exchanges,
anything
so
to
that
do with
does
the
help.
question, really.
Ah, okay. All right.
I have a rental home that I bought in 2000, but I'm ready to sell it this year when the lease is up.
Yeah. Okay.
My husband wants to purchase another rental home in a warmer state with the proceeds, but I'd rather use that money for retirement and to invest it. What do you guys think, Ron?
I think she's the smarter of the two in the family.
I
is what
agree.
I think. There's just okay. Here's the thing. Again, we barely touched on this last time with I guess it was Robert.
Yes, that's right.
You know, having liquidity in retirement is very important, and this is another reason I don't think people, if you're not going to stay in your home forever, would ever want to
pay it
especially
off.
55 and older. You shouldn't be making extra payments to pay off your mortgage, because now you have this great asset that cannot provide income for your lifestyle in retirement. So I don't think that makes sense. So no, and I wouldn't be running off, no offense to Arizona, but talk about a wild real estate market. I mean, that thing went straight up right in the mid 2000s, then it went straight down. I think even the prices have still, what I've read, haven't even recovered to the 2007 level. I mean, this is 13 years later.
As one who lives in a warmer clime, Florida, there was a condominium, an apartment complex that went condo down the street from our house in 2007. That building sold for $485 a square foot for these condos.
Which is, for those of you who don't know, playing along at home, that's a lot of money per square foot.
Price
in any market.
The price today in a hot market. Finally, it's a hot market
Florida's
down here.
been
Finally,
good, yes.
Get this. How many years later is it? 13?
13, yeah.
14 almost. $250 a square foot. So those who
you
paid,
can do the math. That's pretty easy.
those who paid almost $500 a square foot are still down by about half. Real estate is not. It is
And
not.
imagine it's not safe and it's not easy. You don't always make money. And imagine if you needed the cash in that, I'm using air quotes here, investment, right? You got to sell it. Now you got to sell it at half price just to get some of your money back. I mean, I just think making those purchases, and again, real estate for the two of us, I'm speaking for you here, is lifestyle. Where you want to live. I mean, that's not, it shouldn't be viewed as I'm going to get rich doing this unless you're really going to be a real estate magnate, own numerous properties, have them be cash flow and turn it into a business. Okay, go ahead and do that.
But that's a
otherwise,
business.
not
That's
so
not
much.
an investment anymore.
I agree. Yeah,
And
you gotta know what
when
you're
these
doing,
guys
too.
on these podcasters and the like call this passive investing, when you own like 10 real estate that's not passive investing. That's active business operation. And by the way, one of the biggest reasons why, in the past anyway, real estate has felt safe is because there's not a big ticker on the front of the house showing you the change in price from day to day.
Imagine if you're driving to work, your house today went from $491,000 down to $300. Oh my, I got to do something.
Well,
that's
why
people feel iffy about stock markets.
That's why I use past tense, because operations like Zillow are changing that, because you could get the value of your home on an almost daily basis. And
how often can you get it now?
On Zillow, it's all the time, but it used to be you couldn't know it unless you brought in an appraiser.
I see what you're saying.
But now you can go to Zillow and go, oh, wow, my house went way up. I'm selling it. Mine's gone way up. 855-935-TALK.
Tom and Don are talking real money.
Want a free copy of my book, Financial Physics? Well, go download it right now at vestory.com, VESTORY.com.
Reality radio for a really great future. We're talking real money.
Does it seem to you? Oh, by the way, I want to give out the phone number, 855-935-TALK. Call us. We've got lines open now. Call right now.
We do, yeah.
Don't wait, because then you're going to get all bogged down later and you're going to go, well, I didn't get through. Well, good news is you can call us 24/7 too. But have you ever noticed, I have, that the financial services industry tries to make it appear that investing, just putting your money in something, is really complicated, convoluted, and requires all of this advice from these people who are skilled at picking stuff. You know, that part of the business, that part of investing, that is just incredibly simple. It is so straightforward. It is so easy. But there is part of this business that's really, really difficult, but not for the reasons you might think.
Well, and what we're talking about is personal finance, right? Is the plan, because the plan should be central to anything you're doing in terms of investing. And I found it interesting that a young person writing for CNBC, it's about a 600-word piece. The title was "Stop Saying Personal Finance is Simple. It Isn't." And her take was, she's struck by how many experts argue that personal finance is really quite easy. You follow the rules, wealth and happiness will come your way. And then she points out, well, but anyone who struggled to make ends meet, made an impulse purchase when they're sad or happy, or fought with a partner over a credit card bill knows that money is anything but easy. Then she launches into the 5 reasons that personal finance is not simple. It's not, you can't just give the rules. And one of them is, by the way, life is unpredictable. Absolutely. I mean, you may be on a path and then that path has to vary. Families shape our money values. And in her case, one of her parents was an addict. That obviously sets up some very interesting decisions around finance. People want different things. I have no argument with any of those. And by the way, she grew up in Tennessee listening to a guy named Dave Ramsey. So she really
she got some really great advice there.
money advice from her parents and from Dave Ramsey. And then, but where she ends up, I think, is important. She says money is boring and you're not. Totally makes sense, right? That makes sense. Money is boring. And she goes into this paragraph where she says she's interviewed hundreds of experts, including millionaires and billionaires. She's learned
they're not experts. They're just rich.
Yeah. But she's learned that people who are most successful with money stick to routine habits that operate independently from their emotional highs and lows. I remember you recently saying you got to squeeze the emotion out of all this or you'll kill you.
Sounds familiar.
And then she said no matter what's going on in their life, they contribute to their retirement fund. They make on-time payments. They calculate interest rates on mortgage. They make sure their credit score is good. In other words, they do the boring stuff even when it's not so thrilling. So while she says personal finance isn't simple, quit saying it is, she really does point out that there's some pretty simple rules. If you follow them, you're probably going to be in good shape.
Right. But what I think she's alluding to in here is the simple fact that most people don't do very well. The root of this is we don't do well controlling our emotions. She's saying if you take the emotion out of it, do this regularly, do that regularly, do all of these things in a disciplined manner, it's not.
That's the word.
Right. But the problem is being self-disciplined is really hard.
I know. And I got to make a decision about lunch here in just a few minutes. I understand those things. I could either do the fruit Or it could have the chips. The chips sound so much better than
You're
the
going
fruit.
for the
That's
Greek
amazing.
fries.
That's dinner.
Oh,
so
chips and Greek fries? You're dead by tomorrow.
You pointed out the word, though, discipline. If you set things up, if you set up automatic deposits from your income into something that's invested properly, well, then you don't have to worry about it. If you have a method of a discipline as to your spending, then we're always going to have things that we add. Oh, I got to have that. Okay. But if in general you have a discipline about those two things, you're about 90% down the road. And
then you know what, you know yourself. You know your tolerance for risk. You build a portfolio for that tolerance for risk, and you discipline yourself to maintain that portfolio, to remain disciplined in your investments. And now you're at 99% of the battle.
And by the way, just remember, even last year, just investing, you were in the top 96% because 96% of the stocks made money. So you had to be smart at all. I mean, this is very simple.
855-935-TALK is our number. We're talking really important stuff. We're talking real money.
Tom and Don are talking real money.
Is your portfolio a mess? You may have a case of hodgepodgeitis, but don't worry, we can help. Just set up a free, no-obligation meeting with a Vestory advisor at Vestory.com. No sales pitch, guaranteed. That's Vestory.com.
For your real life and real future, Tom and Don are talking real money.
Once again, that number is 855-935-TALK. Good 24 hours a day, 7 days a week. You can call us anytime with your questions, or you can send them in at talkingrealmoney.com, or you can call us live on Saturdays like Irene did. Hi, Irene. Welcome to Talking Real Money.
Hi. I just haven't ever done this before, but I listen to you guys quite a bit, so I'm interested in the real estate angle of things. I'm one of those foolish people that thought real estate was a good idea. And now I have a home in Montana and a condo in Kirkland, and I want to dump everything and have some fun in my life, and I'm just tired of seeing $5 from BECU in my money market, per month, and it's just ridiculous.
I'm sorry.
I don't want to be a landlord anymore. I hate it all. So I need help on investing once I sell my properties, and I'm worried about capital gains.
Well, okay. Yeah.
One's your residence, correct?
I was going back and forth between, yeah?
But is one of them your primary residence?
Yes, the Kirkland condo right now is. I was going back and forth for many years, and then I finally just put renters in the Montana house, and I'm living
Okay,
in
but
the
which
condo
one's
in
worth
Kirkland.
more? Which one's worth more?
They're real close, but probably the condo in Kirkland.
Okay, good. Good. Because how much is the condo in Kirkland worth?
Probably $500,000.
Perfect. How much you pay for it?
The problem, $206, and I only owe $140.
Perfect. You're going to be able to get out of
great.
that one with no taxes. You're going to get an exclusion from capital gains on that. On
$250.
On $250. But the fact of the matter is, she can roll in a lot of expenses that she's
That's true.
Over the years.
So how long have you owned it?
This is my 8th year, but yeah, I had to totally remodel it and put in a new kitchen for 30 grand.
You're
like
so close to having zero taxation on that. And on the other one, remember, your tax will be at the capital gains rate, which is the lowest tax rate.
15.
And so don't worry. Don't take taxes off the table. Just take them off the table, because things that you'll do to eliminate or reduce the tax will also reduce or eliminate sanity from your portfolio.
We as we stated, sometimes the tax tail wagging the dog. People have a tendency to think that. So I would go ahead and sell the condo, and you can worry about the money you get later. We're happy to take your call about that. I mean, we can talk about how to invest it, but
Yeah, that's the thing. You're not ready to invest it yet, Irene. You got to get these things sold, get the money into a bank account. Then it's time. Then it will be time for you to sit down and determine what you need that money to do for you, what you want that money to do for you, and how much risk you're willing to or must take to have it do those things.
I would get that condo on the market by Monday morning. I mean, the market is so hot right now in the Seattle area. Boom. You're going to sell that very quickly. A condo in Kirkland, great piece of property to be selling right now.
I think. I have a second question about the house in Montana then.
Okay.
Can you hear me?
Yes, ma'am. Go right ahead.
Hello? Oh,
Yeah,
I'm
we're
sorry.
here.
I was on my
Rent it to
speaker.
Kevin
I was on
Costner.
my
He's going to be up
speaker.
there shooting.
I thought Don, for the show.
His TV show, yeah. I'm kidding. Go ahead. What do you want to know?
Here.
Hurry up.
My kids, all my kids and grandkids live around the Kirkland area. That's why I bought the condo, because I was tired of driving back and forth. But my house in Montana is a half a block off of Flathead Lake in a really nice area. And the lease is up on that in May. I figure if I dump the condo fast, I could go back and live in the Montana house. And people have told me, but nobody that has any background like you guys do, have told me if I go there and live there for 2 years, I can do the same thing with that house in Montana that I'm doing with the condo.
Yep. Yes, you can.
You were just making me smile when you said that, because I'm going, you can do the same thing all over again.
And you get the exemption again on your taxes, so you're in great shape.
Yeah, that's a bunch of free money.
Well,
Thing smart I've done,
you
because
invest-
to be at this age of my life and not have a portfolio or investments, I'm listening to all these other people and I go, I wouldn't even know what to do.
Yeah, well, it looks to me like how much do you still owe on the Montana property?
On the Montana property, I only owe $155, I think, and I bought it for $260, and now it's the market there is going so fast. Everyone keeps calling me. Every realtor over there keeps calling me. Can we sell your house? Can we sell it for you? And I go, no, I'm just going to put an ad in and sell it myself. I don't need you.
Yeah, you might as well Fizbo the heck out of that.
Nothing's on the market for more than a week over there.
Yeah, then sure, Fizbo it if you can, but live there for 2 years. Live there for 2 years. Go ahead with that one, because you're going to lose 15% of your gain of that 250,000 or so, 200,000. Yeah. You're going to lose 15% of that. It's not real likely that we're going to see the real estate market decline by 15% in Montana over that period. It could happen, but I think that's a reasonable risk to take. Plus, it also spreads this out a little bit. So you're going to get a few $100,000 to invest from the Kirkland property. You can start building a portfolio with that and then add to that portfolio after you sell the Montana property, and then determine where you want to live and what your lifestyle is going to be.
I'd say go ahead and make those moves now and then call us when you got the money. We'll try and give you some guidance. Does that help, Irene?
Hey, yeah, I signed up at Vestory.com, but I never heard from anybody. I've done it twice.
What? What?
Yeah,
Oh, boy.
I went online, I put my name and all my information. No one's called me.
Uh-oh. Hey, Irene.
Neil, you've got my attention.
Irene, you've
now.
got Tom's attention because he's the head of the company. And so his ears just perked up.
I'll go back and do it again. How's that?
Well, would you do that today, please? And as a matter of fact, do me a favor. Just go to Vestory.com, and on the contact form, or no, better yet, just send your information to Tom at Vestory.com. He's the head of the company. He will personally make sure this gets handled right away. Okay?
Thank you for your persistence.
Thanks a million, you guys.
You're awesome.
Love listening to you, and you make me laugh a lot.
Glad to do it.
Thank you very much.
Thanks, Irene.
By the way, one place I would not invest. This is easy.
Yeah?
I would not put it in lean hogs, because lean hogs made they made 6.5% last week.
You're not.
Or this week, pardon me. And
yeah.
you know what?
In 1 week? Wow, we got a big,
1 week,
big fat pig profit.
No, those are the lean hogs.
Oh, those are the lean hogs.
You know
what is a lean hog? Aren't all hogs fat?
And do you know what happened to the fat hogs?
Yeah, I'm pretty sure I know.
They got slaughtered. I'm sorry. Damn it. They got. It was so funny that he made me laugh. They got slaughtered. Okay. Oh, okay. It seemed funny.
You laugh at dad jokes.
I know. I'm sorry.
You really do.
I guess that's really not funny, but I couldn't help myself.
Bulls and bears get rich.
myself.
Pigs get slaughtered.
I know, but it just seemed too obvious when I saw lean hogs were the top performer of this week, up 6.5%. I had to bring up the fat hog joke. I'm sorry. Okay, I'm letting it go now. I'm not though.
Well, this show's over as far as I'm concerned.
Apparently so.
No, really, that
start editing.
That pretty much
let the editing begin.
That pretty much kills the whole thing off. And we were actually doing really well up to that point.
I know. I'm sorry.
It was one of the more memorable shows in a while up to that point. You had to go and ruin it all.
Get the cutter out.
It used to be a razor. Now it's just digital.
That's right, razor. I know.
Talking real money.
Set your course for a great future with a free copy of our 60-page Better Retirement Guidebook at vestory.com, vestory.com.
Your guides to a really great financial future. Tom and Don are talking real money.
No! Stop talking to us, studio. No, we are not going to tell the joke again.
Stacy says, tell the joke again.
No.
Don won't let me. Sorry.
Engineers should not kibitz. This is not Frasier.
Yeah, that's true.
Roz,
they would be
Roz.
there. Yeah, exactly.
Have you ever noticed Stacy does sound a little like Roz in our headphones, though?
Mm-hmm.
She does. She has that same voice. Yeah. I started watching Frasier again because
a great show.
It's coming back.
I know it's coming back. I don't think it's set in Seattle though. Next time.
Oh no,
I think it's somewhere else.
Oh no,
sorry.
Well, that's all right. We only have 20 seconds to remind you that, by the way, you can still watch the Retire Meet videos for a little while longer.
At retiremeet.com, you can learn about how to build a portfolio, how to create income, estate planning, long-term care, Social Security, all of that stuff. It's all free. It's only available for another week. That is retiremeet.com.
We hope you realize that the information provided on Talking Real Money is for educational and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately, consistently predict the future. So past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Vestory, a fee-only registered investment advisor. Thanks for listening, and please visit talkingrealmoney.com for more information and disclosures. That's a wrap.